parting partner was working, and they were all over the place, Manuel. They were, I had a CNC machine shop. I had a managed service provider, managing computer systems, IT technology for businesses. I had a landscaper. I had a engine repair business, diesel engine, for like Mack trucks, refurbishing business. It was just anything and everything. We were generalists, which I would say that, the Main Street and lower end of the lower middle market, is populated by business brokers who have to be generalists because, I guess you could, as a business broker, specialize in HVAC or something, but I'm not sure you could have enough deal flow, to make a living.
Correct.
So you're just a generalist. You just kind of take anything as long as you're matching it to your criteria. And I suppose there's some things that wouldn't make sense. As you can tell from my gray hair, I didn't grow up with technology, so I've had to embrace it in order to be effective in the roles that I play. But I would say that I've seen some opportunities where I just said, I don't know that I'm the right person to represent your business in the market because you have a highly specialized, piece of technology or, something. But right now, I have a party rental business, the largest in the state in which it operates. They have an 80% market share in their state, so it's not a small business. It's a several $1 million revenue business, and 7-digit EBITDA business. But they rent tents and forks and knives and plates and whatever you can think of if you want to have a wedding event or a corporate event. And their client list is mostly Fortune 500 businesses, corporations that use them for their corporate events. I have a towing company that's a very large towing company, multi-generational. They tow for the highway department, for universities, for the city in which they operate, and they have millions of dollars worth of trucks and equipment that they use to do that. I'm representing an HR tech enhanced HR firm internationally. They're Mexico City based, but have a presence in the US, in Europe, and in South America. And they provide, human resources to Fortune 500 businesses across the world. I have a construction company that does build-to-suit properties, buildings for Fortune 500 retailers across the country. They operated in 40 states last year. So, I need to understand how a commercial construction firm works, how a party rental business works, how an HR business, a global HR business works. And that's one of the things I love about the role that I play, because I'm a student of business, and I'm a teacher of business, but I'm also a student of business. And I really love looking at a business that I haven't had a lot of familiarity with and saying, okay, how do they make money? And what does the industry they operate in look like? What's the competitive environment? What are their margins? Because I need to know the business well enough to be able to tell their story in an articulate way to the buyer population. I take that very seriously. I think you probably know that in the lower end of our marketplace, there are people that will just throw financials up in a data room and,
True.
they don't know the business. They don't understand the business. They can't answer your questions about the business. Probably because they have to keep a lot of listings in order to make a living, and they don't have the time to really, dig in. I
Yeah.
operate mostly in the lower middle market. So, you know, I have a $250,000 minimum success fee for the engagements I take. And so at that level, I need to do my homework, and I need to be able to speak intelligently and articulately to buyers.
You're
They
absolutely
also
right.
they also appreciate that. I'll have buyers that will say, and I'm not so much sure it's a reflection on me as it is maybe our industry, is they'll say, you know, you're so much more responsive than the other people I've dealt with that are representing businesses. You know, you know the business, you have a data room set up, you have the right information in it, you answer my questions, you know, you're responsive, you answer your phone. Like, you know, so maybe the
Yeah.
bar has been set too low in our industry.
I mean, I agree. Each time I have a conversation with a broker and they either do not know the financials right, or they do not know where the it's a mess. And I do understand, I do appreciate someone who has all the information that is needed to, you know, close the deal, because that's all it takes in our space though. So in terms of negotiating a deal, what would you say uh, is a strategy that has worked for you?
It's a really good question. I would say that I've worked, you know, dozens of deals in the time I've been an intermediary, and I feel like I learn something new every time. You know, I think that for people in this space like yourself, every deal is an opportunity to learn how the buyers, you know, how they negotiate, and I think it's really critically important that we understand where deals are getting done, the general terms and conditions on which transactions take place. In the questions that I was, you know, or the sort of talking points that I was got, there was a question about the difference between individual buyers and institutional buyers. And, you know, one of the things that I've learned in sort of moving from being a Main Street broker to an M&A advisor for the lower to middle market is the buyer changes. And so now the buyer is typically private equity on the deals that I'm representing, or a family office, and they are sophisticated, and they are going to do a quality of earnings analysis. They're going to beat you up on the net working capital holdback. You know, you're going to have pages of reps and warranties. They're going to put you through intense legal due diligence. That is an entirely different process, an entirely different negotiation than selling the corner laundromat, you know, where there's no quality of earnings, there's no intense due diligence, there's not 15 pages of reps and warranties, there's not a 90-page purchase agreement. And so, you know, and, you know, the biggest issue that you really face is, can the buyer perform, you know, or do they have access to the capital to get it done? Even if they have an SBA lender, you still have some uncertainty about whether the deal's going to get approved or not, or the valuation's going to hold up. So I would say first and foremost that I think there is a significant and dramatic difference between the way deals get done in the lower end of the market, you know, sort of $1 million and less transactions are a completely different animal than a $10 million or $20 million transaction, because the buyer changes. In the small deals, what I found was you typically had an unsophisticated buyer and an unsophisticated seller. And I don't mean that in the general business sense. The seller of the business may be great at manufacturing widgets or doing whatever they do, but they don't understand the world of getting a deal done. So they're not knowledgeable about deals, nor is the buyer, who's typically coming out of corporate America and wants to be their own boss, and they're going to go borrow 90% of the purchase price from the Small Business Administration. And so they've not done it before. Typically, this is their first time to do it. And so what I find is I do a lot of hand holding on both sides of the transaction. I represent the seller, but I'm also coaching the buyer up, which, you know, they might ask, I don't know how to submit an LOI. I don't know what that should look like. How, you know, what does that look like? You know, they don't really understand the process. So on on where I've made a difference in deals, one is I try to have a very good understanding, and I talk to people in my network, to deal attorneys, deal accountants, to the people that perform Q of E's, to find out, what terms deals are being done on, where are the boundaries? Because you can kill a deal really fast by trying to advocate for something that is not achievable. And if you don't know where the boundaries are, you might very well be pushing for something that's not going to happen. And that disconnect between an unsophisticated seller and a sophisticated buyer is really profound. I use the analogy of taking a knife to a gunfight. These folks have a room full of lawyers and accountants, and they look at deals all day long, and they work deals all day long. And that seller, that may be the only deal they do. So I try to focus, one, on understanding, getting an LOI in place that deals with the major issues that I think can kill a deal. And one of the things I've discovered is if you don't deal with the working capital holdback, and I'm talking about lower middle market and middle market deals, it's not unusual to have a multi-million-dollar net working capital holdback on the size deals that I'm working. The seller feels like that's their money, right? It's sitting in the bank in cash, and they in the concept that that's going to stay in the business as working capital for the new owner. It's like, no, I earned that money. It just happens to be in the bank. I use the analogy that it's like driving a car off the lot with no gas in the tank, right? The car comes with the tank of gas. You got to have enough in the tank to be able to, to get home. And businesses, whether you agree that it should be the case or not, the reality is that deals are done where there is a holdback of net working capital. You can argue about how much, but I've never done a deal that didn't have a net working capital holdback. I have found that there are ways to try to negotiate to reduce that. My experience has been that a lot of sophisticated buyers will ask for the moon and the stars on that. They'll ask for more working capital than is really necessary, and if you're not knowledgeable about that, you may very well agree to leave back more capital than is really needed for the business to operate. So I pay a lot of attention to that. In a deal I did recently, I was able to successfully negotiate that instead of, because the business was growing, it had a poor period, a relatively poor year-over-year period, and it was growing out of it. And I negotiated that the look-back period for working capital would be at the time of the LOI was signed instead of it closing. And that ended up being a $500,000, $750,000 swing in the net working capital. So my fee was paid a couple of times over, by fundamentally winning the working capital negotiation there. Reps and warranties, I think, are a big deal. A lot of people will not. They just won't spend a lot of time on that. The last deal I closed, there were 15 pages of reps and warranties and a 90-page purchase agreement. And the buyer wants you to make absolute statements, that I haven't done this, I have done that, as opposed to the best of my knowledge, right? The best of my knowledge, nobody's going to sue me, but, I want to dilute the reps and warranties as much as possible. I certainly want my seller to be able to make reps and warranties on the business that are appropriate, but I've learned sort of where the general boundaries are on that. I think that the notion that you're going to beat buyers up on price in a meaningful way is generally a false premise. What I find is that sophisticated, intelligent buyers, they're very disciplined in the price they pay. Now, if you happen to have a platform acquisition for them and they're trying to get into an industry and you have the exact right player for them, will they go up in terms of the multiple? Yeah, they will. But, are you going to get from a 3.5 multiple to a 5.5 multiple? Absolutely not. buyers are going to use their discipline. They're going to buy at prices that make sense for them. And the reality is, you're not the only buyer, the seller they're looking at. You're not the 10th seller they're looking at. A large private equity firm may look at hundreds, maybe even thousands of deals every year. So if you want to, if you want to try to hold, to mount an argument that is unsustainable, that is outside the boundaries of reality, you're going to lose the deal. They'll just move on to the next thing. So I think one of the biggest values I bring is helping to ground my client into understanding we might be able to win this argument. Let's go fight over here. We're not going to win that argument over there, right? We're not going to get them to go up another turn on the EBITDA multiple, right? They're not going to do that.
True.
There's an old saying, I forget who said it, probably somebody famous, that said you make your money when you buy, not when you sell. Sophisticated buyers understand that. They're not going to be loose on the value.
Correct. I mean, that also, I'm still thinking about the post acquisition. So what would you say is your playbook for the first 90 days post acquisition?
Yeah, so what I will tell you is that my work is largely done as a sell side advisor at closing. If I've done my job well for my client, we have vetted the buyer. We believe that there is a cultural fit. We have a clear understanding of the role that my seller is going to play in the business post closing. And so a lot of that has, if not all of it, has been addressed. You still, when the curtain opens and it's a new day and you got a new owner and you don't quite know exactly what's going to happen. Sellers fear that they're going to get fired the day after closing, or that all the employees are going to be fired. I've never seen anything like that happen. I'm sure there are better players in the industry, but I've never had a really bad actor that I've dealt with, and I think we do a reasonably good job of figuring that out. So generally speaking, I work with my client to get them ready to go to market. I want to prepare a really high quality teaser, a really high quality confidential memorandum. I want to have a data room set up with the right amount of accurate data in there for the buyers. I want to be really dressed up to go to the dance. I want to get a curated buyers list of the ideal strategic buyers. We have a third party that we can track with who has 15,000 strategic buyers in their database. So we don't just take a listing and throw it on BizBuySell and hope that people reach out to us. We'll use a variety of portals to show our businesses that we think could be effective, but we think the best prices are going to come from strategics. So we pay to have a curated list of strategics prepared and to do a high touch outreach to those potential buyers. So we're really well prepared to go to market. We understand the business. We have great looking materials that are that present our client well, but are also in a format that is what buyers want to see, along with the data room and all those things necessary. We engage in that outreach. We try to, doesn't always work. Right now I have two written offers on the table for a business, but we're only 3 weeks into market, and so we still have a lot of prospective buyers that are engaged, and so I don't want to negotiate those offers because I want to get more offers on the table. So probably what we'll do is we will set a deadline for submission of IOIs and LOIs and give the market a few more weeks for people to catch up. And then we'll have a bit of a beauty pageant. We'll negotiate the LOIs. I'll present to my buyer. He'll figure out who, if any of these, he would like to sell to. And then we work hard to get from LOI execution to close. Generally speaking, my touch point after closing is the net working capital true up and any other sort of post-closing adjustments that are going to occur. And that's usually 90 days after closing. So I will reach out to my client in advance of that to say, we've got the following things that are post-closing items that are coming up. Oh, by the way, how's it going? And I'm always a little hesitant on that because, you just don't know, what you may think you've got the right buyer and seller and everything's going to work out. And generally speaking, that's been my experience. I don't have any horror stories to tell. But,
But okay, so I do understand you have dealt with a lot of deals and you have had this immense knowledge that you get the firsthand experience of all these businesses, all the deals going through, the pre and the post. There's so much experience over there. I had a question where if there was a deal that you could go back to, what deal would that be and what would you do differently?
So I had a deal about a year and a half ago, maybe almost 2 years ago now, probably fall 2 years ago. It was a medical practice and specialty medical practice, and it went under LOI for $80 million. It would have been at the time the largest deal I would have worked on. My playing field's kind of $10 million to $100 million of enterprise value, but generally speaking, I'm on the lower end of that rather than the higher end. I don't want to compete with Raymond James and Houlihan Lokey and Stevens. I want to compete with business brokers. I don't mean that in a mean-spirited way, but if I wanted to play competitive basketball, it's going to be in the church league, not the NBA. I know, I know my game. I know where I can compete very effectively, and that is below the investment banks and at or above the business brokers. So it was an $80 million transaction, and I didn't have any offers from funded entities, right? So they were all independent sponsors or newly formed, search funds. One of them was a specialty healthcare, private equity firm. The founders had impeccable C-suite credentials in the space. They had good contacts for capital, but I didn't have a choice of, okay, I've got a $70 million offer over here from a group that has money, and I got an $80 million deal over here where they got to go source the capital for the deal, but they look like they can do it. In that case, I probably would have advised my client, I think I would take the 7/8 of the bird in hand rather than the bird in the bush, as they say, and take less money, but with somebody where the money is going to show up at closing, and there's no doubt. We didn't have that choice, but we went through a 6-month process of legal due diligence, of quality of earnings analysis, of just a very, very deep dive. And at the end of the day, they were dependent, the buyer under LOI, on getting some mezzanine debt financing. The mezz debt market crashed as we were coming to closing. Their financing source went away, and the deal fell apart. And I don't know I don't know that even with my knowledge of what happened, that I could say, well, I would have done this differently or I would have done that differently. Sometimes you're in a position where, and you work deals. So, sometimes there's one buyer, right? And that's it. You don't have 2 offers or 3 offers on the table. You got one buyer, and you're damn happy to have that one buyer, right? And you're just trying to keep them on the hook and keep them happy and, get to closing. In this case, we didn't have a lot of buyers. It was a large deal. Private equity didn't want it, at least, the big players. And so we were dependent on independent sponsors that were going to have to fund the deal on a deal-by-deal basis. But probably I would have tried to get to that if I had to do something different. The post LOI to closing period, which should be a 90 to 120 day period, dragged on for 6 months. I should have probably been much more aggressive in holding them to a timeline so that when the deal inevitably fell apart, when they couldn't fund it, I could have pivoted to somebody else. As it was, we held on to that buyer because they were tens of millions of dollars higher than the next best offer, who also was an independent sponsor. And, you know, and after, you know, taking the client to market, being in market, signing an LOI, and then having this, you know, 6 to 9 month period under LOI, by the time it fell apart, my client was really frustrated with everybody, including me. It was just an intense process that went on too long and didn't get the outcome he wanted. So like anybody that's a professional, you want happy clients. You want to feel like you did everything right. I'm not sure I did anything wrong, but we didn't get the outcome we wanted. And so those are the deals you go back and look at and say, you know, what could I have done differently? It may just be,
I mean, I agree. Since I work the deals, I know exactly what you're talking about. There's sometimes you just can't do anything. But in terms of skills, what do you think we, the ones who deal with deals, should have, and that makes us different from others?
Yeah, I think that the most successful people in our industry have a high emotional quotient. You know, a lot of people can be good at the math and at the law surrounding this, right? What are the terms, you know?
Correct.
Negotiation, people have very different styles of negotiating tactics. I'm not a yeller or a screamer. I don't get angry. Maybe once per deal I might get a little huffy, but you know, I'm very patient, and I want to demonstrate that for my seller and for the buyer. I want to be a gentleman. I want to be polite and courteous and professional. I don't always see that in the industry. Just like in any industry, you've got lots of different personality types. You deal with a lot of doctors. Probably got some really nice, sweet doctors, and you probably got a few that you really don't care for, right? In any industry. So, you know, I have a style for, you know, for negotiating the deal. I think that my background as an advisor to ultra high net worth families, where there was a lot of emotions invested in the management of their wealth, and so a lot of my job was to manage through those emotions. The stock market's way down and they're panicking. The stock market's way up and they want to violate their risk tolerance to go do things, you know, that don't make sense. In my role, I'm working, and it sounds like you are as well, with a lot of founder, owner, operators. They started the business. They've been in the business for a long time, whether that's 10 years or 20 years or 40 years. The towing company I'm representing, you know, is probably 50 years old, and it's the second generation that's running it. So there's a deep emotional investment. A lot of their identity is associated with that business. And so I think that gets overlooked sometimes by business brokers and M&A advisors, as they get lost in the deal itself and they forget that there's a human being that has really profound attachment to the business. So I think just being patient. I also think I approach it as a teacher. I try to teach my clients and explain to them, you know, because it's very common for me in a deal for my seller to say, well, those private equity guys, that family office, they're trying to screw me. You know, they're just trying to beat me up. It's like, okay, well, let me tell you the way they see the world, right? This is the way
I love that.
Yeah.
I love that, because they are oblivious to how they're thinking, you know. And I mean, go ahead, just complete that thing out.
Yeah. So, you know, I mean, I've actually had a client tell me, well, you know, when I told them, you know, this is their discipline, this is how much they're going to pay. And if you don't sell at that price, somebody else that will, right? They're not being mean. They're not nasty people. They just are exercising the discipline, and they've got investors, and they've got to answer to their investors as well. And I've had one say, you know what? They've got all the money in the world. They can pay more. It's like, that has nothing to do with anything, right? You know. Or
Yeah.
I deserve more money for my business. Well,
Yes.
that's not a variable in
Correct.
calculation is how hard you've worked. There's a bottom line to this, which is math, but part of it, I think, is explaining to my clients, this is why they're behaving the way they are. This is why they're proposing this.
Yeah.
Much like the explanation of net working capital. Okay, I understand that you feel like you made that money and you've earned it and you should take it with you. That's not the way deals get done. So, I might feel like if I sold you my car that I didn't have to leave any gas or oil in it, but that's the way deals get done. If I didn't do that, then I wouldn't. That's not an acceptable practice. So this is the way deals get done. This is the way buyers are looking at your business. It doesn't always work, but a lot of times it'll kind of diffuse the emotional aspect of it. A lot of the deals I do, Emmanuel, are not full sales. They're what we would call majority recaps. The last two deals I've done, my sellers kept a 20% equity stake in the business and stayed on. They changed their role in the business.
Okay.
And that's something that most sellers don't necessarily understand. When people come to see me, I kind of feel like I'm an emergency room, right? And they come in and they're bleeding from someplace. And it's either I want to sell my business because I'm sick and tired of it, I'm exhausted, or I'm ill, I've got a health issue, or I just want to retire and monetize the value of the business and go sit on the beach. They really want to grow the business, but it takes capital and they're not willing to invest more capital, or they don't have access to more capital.
That is true.
Or they want a partner. They don't feel like they can, it's not a capital issue, but they feel like that to grow to the next level, they need somebody that can bring a skill set that's complementary to theirs to help them grow. So my mother, my very southern mother from Columbus, Mississippi, used to tell me regularly, son, God gave you 2 ears and 1 mouth, and you should use them in that proportion. That was her polite way of saying you talk too much and you don't listen very well.
That is very polite.
Yeah. Very southern way of insulting your child. But what I would say is that the better skill in dealing with the client on the front end is to listen and really listen to what they're explaining, because a lot of times they may present as a business seller, they really don't want to sell their business, or they don't want to sell all of it. And so the last couple of times, I sold the business, a large commercial landscaping firm. The seller was young. I mean, he's probably 40s. And he said, I don't get to see my kids' games at school. I'm not home in time for dinner with my wife, and I've made a lot of money in this business, but I'm not experiencing the quality of life that I want. I don't want to sell the business because I think there's a lot of growth left, but I really would love to have somebody come in as a strategic partner and provide capital and bring in operating expertise. So the buyer, it's a private equity firm that specialized in his space, that had done deals in his space and knew it very, very well. And they installed at closing, a COO to step in and take on the operating responsibilities of the business. He slid over into a business development role, which was his strength. And in his employment agreement, he gets Fridays off. So he gets to go play golf, and he gets to go see his wife and kids. He gets to leave during the day to go, so he's going to be measured on business development. But he said, I never want to get a call at 8 o'clock at night again from somebody where they wrecked a truck or have a broken weed eater. I'm done with that.
So this is something new to me, because mostly I'm dealing with the buyer who either completely wants to acquire it, turn it into a roll-up, a bigger franchise, and then sell it to a hospital, or even lately I've been looking at a lot of trailer repair HVACs, and they're doing something similar where they're rolling up, turning into a big brand, and then selling it to a VC firm. And all they do is they update their SOPs. I have not seen a deal where the owner is willing to stay as a part of the deal And does that happen often, or is it just something that is recently becoming a thing?
It does happen often. It has not historically happened in the Main Street market. And part of that, Emmanuel, is because the SBA, until recently, the rules didn't allow the seller to stay on. So you didn't have a choice. The seller had to leave. I don't.
Correct.
I'm not. That's not my space. Although I do occasionally work smaller deals, that's not where my expertise is now. I do know the SBA's changed the rules, and the seller can, I think, continue to have a portion, some ownership, and and continue to work with the business. So, but part of it was just structural. The people lending the money wouldn't let you do deals like that. But in the larger space, I think that it's much more common, and I think it's more common because you have owner, founder, operators that grow the business from zero to. My guy, the last deal I closed was 30. He was doing $30 million of revenue, and going from 0 to 30 million is an extraordinary accomplishment. But he didn't have a lot of, he didn't have much middle management. So basically, it was very owner dependent. And he was working 80 hours a week or more, and he wasn't enjoying what he was doing, but he still felt like the business could go from 30 million to 60 million to 100 million. And so I think in the lower middle market and middle market deals, it is more common for a founder, owner, operator to say, I'd like to keep part of it. I just need a strategic partner to come in and help me. And there are some deals that get done where the strategic comes in and takes a minority equity position. That's not that common, but I have talked to a few private equity firms that won't require a majority of controlling interest in the company. They'll take a 20% or 40% stake. But yeah, it is. The simple answer to the question is it's very common. The last 2 deals I closed were done with the owners doing an equity role in the business, ROLL, and staying on, albeit in each case, one of them was an architecture, engineering, design firm. The engineer was way too busy running the business, and he wasn't practicing engineering. When they asked him what he wanted to do, he said, I'd like to be an engineer again. So they bought 80% of the business. He got to slide over and do his craft, which he really enjoys, and get out of the headache.
Yeah.
Operations, very similar to the commercial landscaping business. The guy didn't enjoy what he was doing in the business. He really wanted to narrow his focus into things that he was better at and would enjoy more and get more and basically buy back more of his time, in his language, which he did. I've got a client coming to market here pretty soon that wants to bring in a strategic partner, and he wants to keep as much equity as he can, but it's a fairly capital intensive business. For him to go from where he is to the next level, he would have to invest probably $1 million, $1.5 million. He doesn't have the resources to do that, or if he did, he'd have to borrow it, and then he'd leverage his balance sheet. He's not comfortable with that. So he'll be looking for a partial sale to a strategic. So yeah, I see that a lot.
Interesting. So that brings me to a question. What would you advise the sellers who are considering, or business owners who are considering selling their business? What would you advise them?
Yeah, well, first I would do as my mother advised me to do. I would listen, and I would try to understand, one, they really want to sell their business, or is there something else they're trying to achieve and they just don't understand that there are other choices. You could sell some of your business, you could sell all of your business, you could not sell your business. You could sell it to your employees in an ESOP. There are lots of ways for you to maybe achieve the goal you have. So first, what are you really trying to accomplish? If they really want to sell their business, I'm sick and tired of running it. I want to stop doing it. I'm miserable. Or I got a health issue, or I'm 75 years old and it's time for me to wind down and I want to exit. So the first thing I would do is try to get a basic understanding of what they want to accomplish, and is it really what they're telling me? Second would be to get a pretty good understanding of the business around what I'll call sort of the 4 pillars of a saleable business. So one is owner dependence. The more dependent the business is on the owner, the less likely it's going to transact at all. There's some businesses that are so owner dependent that a buyer simply won't take the risk, that they buy it, and the customers and and employees walk out the door, and the intellectual knowledge of how the business operates walks out the door. Books and records, particularly in the lower and middle market, having GAAP, books, and if possible audited, makes a big difference. You're going to go through a quality of earnings analysis. They're going to tear it apart. The better your books and records are, the easier the transaction's going to be. I have a client that I signed up in February. It's July. We haven't brought them to market yet because they don't have good books and records, and they're having to have their accountant go back and basically create and repair them so that we can take them to market. So owner dependence, good books and records, customer concentration. I had a client a number of years ago, and 100% of his revenue was from a single client. That was Walmart. That's a great client to have. But I can tell you this: if Walmart finds a better vendor, tomorrow at a better price, my client's out of business.
That's a tough one.
It's a tough one, so owner dependence. Let me look at my notes because I always forget one of the four. Owner dependence, financials. Customer and supplier contracts. I try to understand if there's recurring revenue. In my space, in the lower and middle market, recurring revenue is the man. They will pay a much higher multiple for recurring revenue than they will for even if it's reoccurring revenue. That they don't weight that the same as so. If you have the ability to turn your clients into subscribers or turn them into, contracted clients, that's going to really enhance the value of the business. I've got one more that I know I'm leaving out. Well, I'll remember it when we get off the call. But fundamentally, there are some things that a client can do to repair the business. And if they're not sick or so burned out that they're not willing to take some time, I would say, look, if you can bring in a fractional COO, CFO, if you can bring in a business consultant that has experience here, if you can. I'm sorry. The fourth one is so obvious, and it's systems and processes, right? You mentioned standard operating procedures earlier. A lot of founder-led businesses, the systems and processes are in the owner's head.
Yes.
That's not good, right? That's scary to a buyer if it's not written down. My business, Optima, which is an extension of what I've been doing for a long time, but it's a year and a half old. I've got written processes and procedures. I've got a process flow chart for everything we do to get a client, to onboard them, to take them to market, to get a system prepared, a teaser prepared, evaluation done. So everything is captured. If I get hit by the bus tomorrow, somebody can walk in the door and take that notebook off, and they've got every vendor we work with, every professional, all of our software, everything is captured there. So systems and processes are a big deal. If you combine all of those, owner dependence, customer concentration, books and records, standard operating procedures, businesses that have those things in place, I like to say, and I'm not, if somebody could challenge me on the math and probably prove me wrong, I like to say that 95% of businesses, small to medium businesses, are going to trade between 2 and 4 times their cash flow.
Correct.
5% are the outliers. Now, I'm not talking about $100 million businesses. I'm talking about small to mid-sized businesses.
Yes.
And if you think about that, why that's the case, it's a cost of capital function. It's an internal rate of return function. If I buy a business at a 4 multiple of their cash flow, and I can keep that cash flow, it doesn't go away when I buy the business. It's sustainable, and on a cash basis, it's a 25% return. I'm paying $1, for 25 cents of earnings, and as long as that 25 cents comes in every year, I got a 25% return. as I
Correct.
used to tell my wealth management clients, everything is a function of risk. You don't want to take any risk, buy a treasury bill and make 3 or 4%. If you want to go buy small capitalization stocks in emerging markets, you're going to have a 40 or 50% drawdown from time to time, but you might make a 16% annual rate of return. You want to go buy pork bellies, God knows, right? But you just start stacking returns on top of risk. So what's the risk of buying a small operating business that's illiquid? That if the owner dies, there may not be a business that survives it. What kind of return do I have to get in excess of the return I can get from buying the alternatives? I can go put my money in an S&P 500 fund.
Correct.
Probably make 10 to 12% a year on average, right?
There are so many. Yeah, there are a lot of financial tools that can actually get you the return that you're looking for as an investor, but it takes more than just running a business to actually make a lot of profit in a business. I see most buyers do not know what kind of business they're getting into. They don't know the industry. They have certain skill sets. They come from an IT background, so that they think that by implementing the SOPs or by implementing tech in a blue collar job would make it better. But I have seen, for most cases, all it takes is just a phone call and getting clients. Sometimes sales guys win the lottery by getting these blue collar businesses rather than the tech guys. And it all depends upon what you bring to the table as a buyer too. The business that you're acquiring, yes, it's going to make money, it's going to get you home, but if you want to make more, you got to bring in the set of skills that the business requires to grow. So that's something I also look out for in terms of I deal specifically in healthcare, so my new client is going to be the new buyer, right? So I make sure that they can 10x the multiple with their skills, and at the end of the day, we all are satisfied and we all are growing in the industry, and I get to learn more about the business from a new buyer with some new skill sets. That is incredible. And sometimes, so here's the question to you, touching on that topic. Do you what do you foresee in this M&A space? What's going to happen next? What does the trend look like? Because I believe from 2020 to 2025, I saw a lot of HVAC companies getting bought. And where do you think what do you think is going to happen next from 25 to 30?
Yeah, well, let me touch very quickly on what you said, because it's profound and really important. Is we have a lot of people out there that are looking to buy a business, and they don't really, they need to do a self-assessment and figure out their strengths and weaknesses to match up with the business. Generally speaking, a business owner, particularly a founder owner that's selling their business, they were either really good at operations or they were really good at sales. It's very rare that you find someone who's very good at both. So generally speaking, if you find a business you want to buy, you can see that either I can go in and clean up the operations and bring tech and do these things that will really make the business hum. I got a great salesperson over here. We don't have a problem with revenue. We got a problem with managing the systems and processes that generate that profit. Or the systems and operations are great, right? They don't really need much over there. What it needs is somebody driving top line revenue. And if I have if I'm a salesperson, then I can go into that business and keep that operator and then go sell. So I think you're right in that a lot of people approach buying a business and they kind of look at something they think will be fun and interesting, and they really don't think about where is the opportunity set in this particular business? Does it align with my skills? So in terms of what's happening in the industry and what I see, in terms of the types of businesses that will be the shiny object for buyers going forward, hard to predict. I think it's a game of lemmings, that somebody leads the pack and starts buying up. and everybody sort of buys into that same trade. And then, you know, and you get this massive movement of capital into a space, because there's a certain safety net there, because you know that if private equity is buying it, that there's a, you know, that you can move into that space, and you can theoretically exit, you know, if as needed. I don't know where they're going to ultimately migrate next. What I would say is the trend that's really powerful is my generation of baby boomers are. I've heard a statistic. I'm reminded, I think it was Will Rogers that said there's lies, damn lies, and then there's statistics. So I don't know whether this one's true or not, but I've heard that more than half of the privately owned small businesses, small to medium businesses in the U.S. are owned by people 55 years of age or older. So that's my generation. I've also heard or read recently that there are approximately 900,000 of those business owners retiring every year for the next several years. So as my group ages and we decide that we either have a health issue or we just don't want to work that hard anymore, we're ready to monetize the business and move on, there's going to be a generational transfer of these businesses to that next generation. And based on the math that I've seen, unless a whole lot of buyers show up, it's going to be a buyer's market, because there's going to be a lot of businesses available, and more businesses available than have ever been available for buyers. And if the buyers don't fill the void, then I think the biggest issue in the marketplace is going to be, how are these small to mid-sized business owners going to get a successful exit if you have an imbalance between sellers and buyers. And there's some chatter that your generation, that people your age aren't really interested in buying and owning and operating small to mid-sized businesses. Although I get calls from them every day, from folks that are, you know, looking at, you know, entrepreneurship through acquisition. And they've read Walker Dibel's book, and they've read other books on buying businesses, and they've run the math, and they've realized that they can go buy you know, a $1 million EBITDA business for 3.5 multiple, 3.5 million, and they can borrow 90% of that, you know, or 2.7 million from the Small Business Administration. Not to minimize that, you know, you're going to have to put a personal guarantee on it, and you may lose your house if you're unsuccessful. Correct. But I'll tell you an incredible statistic that I read recently, and that is that for startups, 90% of all startups fail. 90%. Yes. So if you start a new business, you got a 10% chance of being successful. For VC-backed companies, venture capital-backed companies that take an average $40 million in capital to launch, they have a 75% failure rate. Okay. Yes. These are companies getting $40 million on average from venture capital investors, and they're failing at a 75% rate. The failure rate on businesses purchased with SBA loans, 2%. You 2%. Said it. Right? Yes. So what, you know, just look at the math. I mean, where would you want to put, why would you want to start up a business and have to overcome that 90% likelihood that you're going to fail, when you can buy a business that has existing revenues and profitability and cash flow?
You are so right. I sold 2 businesses and I ran 3, and I'm running the 4th one right now. And no joke, I feel at this point I should just start acquiring businesses, because at the end of the day, I will pay an X amount for clients, for something that has already done its marketing, operations, got all of the things right. Rather than me figuring it out, that's going to cost 2X of that X amount, twice as much, just for me to get there, and my time. Trust me, our generation is thinking way beyond just starting something from scratch. We would want to keep on the legacy of someone else going, because at the end of the day, you know, it's like taking over a farm, right? They have planted all the seeds. They have turned that farm into a forest. Now it's your, turn. And
Yeah.
I do love how my generation is outsmarting my parents, where my parents would start from scratch, start their own business, go to a bank, take the loan, do the same procedure, but start from scratch. And that makes a huge difference. And the reason why we started this podcast is for our generation to understand the opportunities that have opened up, and they're going to be there for the next 5 years. So we have to build our skills based off of those. So, for example, Valentino and I are looking at buying a trailer repair, right? Valentino comes from the trucking industry. He has run shops. I come from a business perspective where I know if I implement few strategies like roll-ups and few other financial strategies where I can profit off of these small single shop locations on a long run, right? Implementing tech, getting the sales right, getting the SOPs right. Most of these trailer repairs, they do not have that in place. And they just have one or two mechanics and they're making millions, right? So guys of my age, or they do not want to buy a blue collar business. They
Right.
they want something fancy. And
Sexy.
that just gives us, it just
Yeah.
gives us more opportunity to get into a market that's so underlooked. And you're absolutely right.
You can buy businesses that are unsexy at a lower multiple because there are less people chasing them. It's just supply and demand, right? Who wants
Right.
to buy a porta potty business? I do. I'd like to buy a porta potty business because nobody wants to be in it. And every time there's an event, festival, there are porta potties going out there.
Yep.
And it's a small industry, relatively speaking. And so you're not going to have, the only way a private equity is going to play there is if you aggregate, right, and get it to a size where it makes sense to them.
Correct.
Snow removal, specialty trucking. They're industries that are boring, that don't really have a tech component to them, but they're not going away. They're recession resistant. And you're buying the existing cash flow at a lower multiple. You have a bigger margin of safety for your investment. If I were your age, I would be looking at, there's a whole lot of businesses that are going to be transitioning. And if I put myself in a position where I qualify with the SBA, which most people do, I can go borrow up to 90% of the purchase price.
Correct.
And I could build a portfolio of operating businesses with a 2% failure rate, I could take half the cash. I mean, think about it. You buy $1 million cash flow for $3 to $4 million. You take half the money that cash flows and use that to pay yourself or to reinvest in the business, and you take the other half and pay down your debt. At the end of X period of time, you have no debt. You've got a business cash flow. You're growing at 5% a year. The internal rate of return on that is just crazy. So
yes,
I think it's a great time to be a buyer of businesses. It's probably not going to be an ideal time for sellers of businesses over the next 10 years as my generation ages out. With that said, the one thing I tell clients is if you have a business with good systems and processes, with good books and records, that's not heavily owner dependent, and ideally doesn't have customer concentration, and you're producing positive cash flow, there will be a buyer and they will pay you a fair price for your business. It's the businesses, it's the businesses that have some problems in those areas that make it difficult, if not impossible, for a buyer to. And the SBA won't underwrite businesses that have some compelling issues there as well. So you lose the funding. So anyway, it's an exciting time at your age and in your space.
Well, Lane, thank you very much for giving us your time, talking about what you do, how we can tell the audience what they're looking for, what they should be doing. I appreciate your time, and I thank you very much for being on this podcast.
Thank you, Emmanuel. I enjoyed it. As a podcast guy myself, I run a podcast called The Deal Table. And I talk to people who bought businesses, grown. I also talk to private equity investors. So I try to get people from both sides of the table. So I have great admiration and respect for people in the podcast game. And I'm honored to have been able to join you today.
Thank you very much. On a last final closing note, what would you tell our listeners who are buyers and sellers, some red flags that they should look out for, and if they call you, what are the questions you can answer for them?
Red flags, my goodness. I would say that a potential red flag that I see in buyers particularly is they set up a timeline to go buy a business. Usually it's something like 2 years because they've saved money and they're going to live off their savings while they go look for a business. And they jump out into the world and they start talking to business brokers and looking at biz buy sell. And, you know, after 9 months, they're still out there fighting and scrapping, and they get fatigued. They get over eager, and they end up doing deals they shouldn't do because they're so concerned that they're not going to get a deal done that they end up. My dad was, you may not remember Yogi Berra, but he was famous for malapropisms of saying things that were contradictory. And my dad used to tell me, I remember I was working on a deal that didn't work out years ago. He said, son, some of the best deals I've done were the ones I didn't. Which doesn't make any sense, except that what he was saying is sometimes when things don't work out, there's, that's okay. And so the red flag I would say for buyers is don't chase deals. That there's going to be a preponderance of businesses available for people to buy. Be patient, and stick to your discipline. Know what you want to buy financially, what you can afford to buy. If I'm a buyer, I would go get a pre-qualification letter from the SBA. As somebody who represents sellers, I really don't want to talk to people if I don't know if they have the money to pull a deal off. If they can show me, hey, I've already gone to Huntington Bank and I've got a pre-approval letter for up to X value, I'm ready to talk to you. So I would say know what you're looking for, be disciplined about it. Don't chase deals. Be pre-qualified so that sellers and their intermediaries will take you seriously. On the seller side, I would say don't make the mistake of thinking that no matter what your business looks like, it's going to sell. Don't be unrealistic about the valuation of the business. If you're selling your house, you can go get a realtor that'll run a multiple listing service report and tell you, hey, Emmanuel, there's 10 houses that sold in your zip code over the last year, and they range from this price per square foot to this price. If you're the best house in the neighborhood, maybe you'll trade up here. If you're the worst, down here. Correct. I can't tell you how many sellers I talk to who have a grossly inflated expectation of the value of their business. And it keeps them from transacting because they're anchored in this unrealistic valuation. And because there's not a multiple listing service for businesses where you can go look at the data and say, I run a snow removal business in Montana, what is my multiple, right? So they tend to be misinformed. They read that Elon Musk did a deal at a 40x, and off they go, right? And I think the biggest red flag for buyers is be disciplined, be patient, don't chase deals, be pre-qualified, look good to a seller so they see you as being credible and want to work with you. For sellers, I would say, one, start as early as you can so that if you need to clean up your books, if you need to reduce owner dependence, if you need to get systems and processes in place, if you're doing, $500,000 of cash flow and you can move from a 2 to a 4 multiple by doing those things, you're talking about getting another $1 million, right? In your pocket on a sale. So be prepared to do some work. Don't wait until you have to sell, and then hire a professional. By all means, hire somebody to represent you. The success rate for people that try to sell their own businesses is remarkably small. It's still small when they hire some professionals. Get the odds in your favor. Be prepared. Understand what your business is worth. Engage with a professional, and be prepared to sell, and understand it's going to be emotional. Well,
Lane, you nailed it. That was perfect. Well, thank you very much for being on the podcast, and